Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I'm delighted today to have with me Tim Sykes, CEO of Proactis, a leading global business spend management software firm with around 90% or there and thereabouts, 90% of its £50 million turnover coming from recurring revenues or SaaS-related activities. So welcome, Tim.
Hi, Paul. How are you doing?
Very good, yeah. Now, just for sort of like the benefit of investors, can we just really sort of walk through a couple of real life examples? So let's just assume, for argument's sake, I don't know, I'm a sort of like finance director of a European consultancy business, number of sites around the continent. It's sort of a property everywhere. I've been hit hard, like everybody else, by COVID, and I've been the finance director. I've got the sort of like the short end of the straw to reduce our cost base. What can Proactis' software do for me, and how much sort of cost could I sort of chunk out? And let's just assume, for argument's sake, I don't know, I'm a £200 million turnover, and I do overheads, indirect costs, 50% of that, so it's 100 mil, for instance, just to make the numbers easy.
Yeah, so really difficult. Depends on the existing operations of the customer and how far they advance down their digital transformation process. Ultimately, the software enables our customers to make things more efficient whilst not reducing or not increasing any risk in terms of their corporate governance profile. So savings of 10, 15, 20%.
Yeah, so if I wanted to reduce my footprint, because I don't know, I've got 10 offices around Europe, and they're all, I don't know, 5 million each in total. And I want people to go hot desking, just doing tenders for the likes of, I don't know, Regis or these kind of guys. If it was a pan-European tender, would the software be able to do that for me?
Yeah, absolutely. I mean, that's where we fit well. That's what our customers come to us to enable them to do, to be able to automate and centralize, to get better buying decisions, to take purchasing decisions from being off contract onto on contract, taking out all maverick spend so that you get professional buyers sourcing from professional suppliers at best value market rates. That's entirely part of what we do. That's the value proposition of getting cost of goods down. But then also, really importantly, there's automation efficiencies. So there's an awful lot of grit in the machine around people processing paper and or other PDFs on documents. This all takes time and effort from folks for non-value added processes. So our systems enable that to all happen in an automated way through digitization rather than through manual process, taking grit out of the machine. And that's where you get the automation efficiencies, which is the second part of the story. The third part of the story, of course, is you can't afford to lose control of who's spending what. And that's the corporate governance compliance part of the value proposition.
And what about the sort of transparency? I mean, let's just say, again, I have 10 offices, etc. They're all separately, locally buying cleaners, I don't know. And I then get a sort of like, I think, right, I can save 10% by putting that out to a European contract.
Yeah, but I mean, that's exactly the point of using software rather than people, because you get that centralized transparency of all people that are using the system, buying everything with a pre-arranged purchase order. You get a total clear view and all of the data is collected. If you have a dispersed system with people doing things locally on paper, that information doesn't get into a central repository that people can use in order to analyze spend better, and that starts the cycle of efficiencies again.
And what's sort of the USPs of the company in this? Because I mean, I'm guessing most people won't be using pen and quill for this sort of stuff. They may be, but if I'm a mid-sized company, I'm probably not.
Surprised. I mean, it's mainly Excel, but you'd be surprised.
Okay. So, I mean, just what are the USPs if with the sort of your competitors anyway? If there's still a reasonable market runway ahead to penetrate the market, if you're in a head-to-head with one of your rivals, what would be the sort of key selling points for Proactis?
Yeah, so I mean, Proactis it depends which angle the competitor's coming at, but we are the value player in this space from the international or the global providers. We're the value player, so you get a much better deal. We're the best fit, certainly between feature, function, capability, and price, no doubt at all. And then the second area is you're dealing with a fast access to the benefits. So our implementation is super fast. 100 FTE days to get the system up and running into the environment, against sometimes certainly many months and sometimes even years with some of our more engineered competitors in that sense, who might go to market indirectly with a KPMG consultancy practice. And even the implementation can often be done by third parties in those global competitors. Local players, we obviously play on skill, capability, breadth of the offer, which is an end-to-end suite, whereas most folks at a local level are point solutions. So we've got the best balance of breadth of the suite, feature function capability, and price.
So effectively what you're saying then, if I've got about 100 million up there, basically on spending, and you only save me 10%, that's 10 million per annum, and you can basically implement the whole system. That was it, 150 days compared to a year or so? Okay, so effectively more than a half less than others. So you save me 6 months, you save me 5 million straight away just on implementation period, and then you can save me another 10 million on an annualized basis.
Yeah, depending on the current state that the buyer is in terms of their digitization process and how and what their current systems and their current processes are delivering. But certainly we see those kind of returns, very, very fast return on investment or cash payback. Yeah. And
I mean, in this environment, that just says that lots of people are going to be interested. They're absolutely wanting to cut. I want to cut costs, and they should be right in the sweet spot, I'm guessing.
Yeah, well, there's a couple of sort of macroeconomic drivers. In a downturn, you'd think that we're sort of counter-cyclical. Spend management is an important part of it. We're a bit sceptical about that, but you're absolutely right. In reality, all people should be looking at costs, certainly indirect costs, which are generally non-processes. People should be looking at that. And of course, in this environment, when everybody's working remotely, you need an automated workflow. And therefore, we provide through cloud computing, we provide that because there's a centralized system. And then security as well is a major issue, particularly in these times where, a highly secure environment driven in the cloud is a long-term driver that people must start to adopt these systems if they're not already. So, yeah, you're absolutely right. All of the longer-term and short-term current issues are well covered by our solution.
So COVID, you're saying basically, which makes sense, is going to be a long-term positive because it's accelerated that sort of like move to remote work.
Yeah, I think it helps as a step change ultimately. I mean, how long the market reacts to that in terms of dropping in the pipeline, because there are other balancing items. The other, the balancing issue is that in these times, CFOs hang on to their cash and make their investments at a slow rate. So
yeah, you're right.
But that kind of thing can balance. The drivers of the product is, absolutely unquestionable.
No brainer. Yeah. Okay. Just moving on to the other sides of the business, the supplier software side. What does that actually do in terms of benefiting the suppliers rather than the actual people purchasing it?
Well, so the first thing to say is that all of the supplier paid products, first of all, have a value proposition to the buyer. Because we're talking about communities here. We're talking about buyers with very important supply chains to them. And therefore, everything that we do with suppliers has to be coordinated and be of value to buyers in the first instance. But the services that the supplier pays for are, number one, they can pay for the transactions that they send electronically back and forth between their customer and themselves. Number two, they can get access to greater number or quality of tenders that they might be able to bid against their own parameters. And number three, they can pay for an early settlement in terms of a discount against an invoice that they have with a customer. So those are the three main areas. And where obviously the last one is new to market. We don't have revenues from that product at this stage, but the pipeline is really strong and we're very comfortable that in the short to mid-term we'll see good traction in that area.
So presumably then on the supplier side, given it's sort of like transaction related, it's sort of taking a clip off the invoice price, etc. Then I'm guessing you probably saw a bit of a sort of like a dip straight in the immediate aftermath of COVID. But overall, you would have thought as the economy is getting back, it's sort of like transactional revenues would be slowly recovering after initial dip, I don't know, in the spring.
No, that's right. I mean, we saw the issues immediately following lockdown in the UK and into Western Europe. I mean, we get good visibility on spend data, and our customers are internationally spending 500 billion a year. So it's a good population for us to be able to assess. And in April and in May, we saw volumes down at 60% of pre-COVID levels. We've seen that build back up to 80 or 90% levels. Now, of course, in our transactional volume areas, we've seen our ARR reduce by about 12% year on year. And that's just a match of essentially of the volumes that are going through. But we expect a rebound of that as the world comes out of COVID in due course.
Yeah, and once we get a vaccine, I think there's going to be a huge leap in business confidence. So you'll probably see that one moonshot, hopefully.
Let's hope so. But I mean, Proactis has performed really, really well. And despite we've lower revenues, we've also had natural cost savings, and therefore we've delivered pre-COVID earnings during the COVID period. And we're projecting forward to maintain pre-COVID guidance for FY21. So it hasn't impacted us from an earnings perspective in any way, really.
Yeah, very sort of stable. And just that split between the sort of the business spend management software side and the supplier side, is that a sort of like a 75-25 split, is it, in sort of like ARR?
Right now, we have about 8 million of ARR from supply side, you would say. Again, it's all part and peripheral spend management in the whole scheme of things, but about 8 million from the 50 is in supply side.
Okay, and then you've got this new project, which is basically advancing funding on small purchases for suppliers called Be Paid. How are you seeing that, and what do you see the longer term sort of like trajectory of it?
Well, we think it's we have a massive opportunity here. I mean, we have a great opportunity in business spend management because we have 5 superb territories that we can play in, where we can be very, very competitive in, and we're through the strategy reset that we did in April last year, only just starting to get into. That is flowing now, which is really super. Early days, but really super stuff. Be Paid is at exactly the same level. Give you an indicator on an account by account basis. What we would expect to see is that the value of an account could easily double if the buyer adopts the Be Paid solution.
Right.
Think of it as from a buyer's perspective. Think of it as an additional module that they're buying. And from that perspective, it would, and a buyer can pay us for it as it's a buyer paid model if they want it to be. It's so flexible. If it's a supplier paid model, then the revenues go high, but we have costs to offset against it. But the opportunity is huge, and there's our proposition here is that we would look to be building tens of millions of revenue over the coming 2 or 3 years from that product alone.
And is it small value items purchasing? Is that the idea of it?
Well, this is the unique positioning of the solution. So in the invoice discounting world, if I could use that broad umbrella, we're targeting our solution at the tail spend of a buyer's supply chain, which is historically very poorly paid. And in a 100% automated piece of software, we're able to accelerate a payment to a supplier down to 3 minutes.
3 minutes
on an initial acceleration, and then on subsequent accelerations once the suppliers onboarded themselves within 30 seconds.
Wow, God. Well, I hope that 2.5 minutes makes a lot of difference. It wouldn't to me, but hey, that's pretty quick.
It's incredible. It's a market leader, and we can take that solution into invoices down to certainly less than £500, which is unique.
Right. Okay.
Nobody's playing in that space. So we have and that makes it obviously complementary actually to other invoice discounting solutions that are out there, to larger suppliers with larger invoice values. So it's complementary to a buyer's overall solution set.
I've never heard of anything like that at all. It's all big ticket items when they forward fund. No,
I think there's a webinar that FinCap took, which is available, I think, for people to have a look at that.
Right. Okay.
A 40-minute presentation of that, and I think it's available for people to go have a look at.
Okay, so let's just again, I'm just going to put my hypothetical hat on. I'm a contractor. I've got a number of different sort of like customers, and I invoice them, I don't know, let's say once a month, and I'm invoicing, I don't know, £1,000 each time, and I've got, I don't know, not quite, but that sort of stuff. This would be ideal for me, presumably, wouldn't it?
Yeah, it would be fantastic if you want to gain control of your cash flow.
Yeah.
And to pay a little bit for it through a discount.
Yeah.
Then on a standard 60-day terms with your customer, you could accelerate that to whatever time it takes the buyer to approve the invoice. So it's only against an approved invoice, of course, it would be. It's only against the invoices that the buyer subscribes to. So it's buyer-led in that instance. But those invoices are available as soon as the invoice is approved. So it could be 3 or 4 or 5 days post-delivery of the invoice when the supplier sends the invoice into the bank, it could be 4 or 5 days afterwards, rather than waiting 60 days. And as we've said earlier, cash is king in this environment, so it's very relevant to this stage of the economy.
Okay, so we've got some on the growth levers. We've got basically the economy, which should be giving you a perfect sweet spot in the fullness of time. We've got revenues for the transactional side, which the supplier side, which should be coming back next year, and we've got the BPay new product and stuff. What are the other sort of levers as part of the group's strategy to drive the top line growth?
Well, I think the single biggest one is the extension of the strategy that we already have in the UK and the Netherlands on our business spend management suite, where we sell, let's say, 60 or 70 new names per year into each of France, Germany, and the US. So the last 12 to 18 months, we've put all of the right teams in place to be able to service that, and supported that with an internationalized product on a single platform that enables those 3 territories to perform at the same level. Now, as an indicator, we just reported that we've done 50 million or so of total contract value. That's the new business that's been signed in that year, with probably about 10 of that was from just the UK and the Netherlands. So we expect to be able to see that ramp up significantly over the next 2 to 3 years as those teams become more mature and more adept at signing the mid-market size customers in each of those spaces. So I see us being able to accelerate total contract value from 15 million or so, certainly north of 25, 30 million over the next few years as we make those 3 territories behave in the same way as we already do in the UK and the Netherlands. So we've got some really attractive growth drivers, macroeconomic stuff telling us that what we've got is in the right place for the right time. We've got our business spend management solution, which is reflecting or transforming France, Germany, and the US to match the performance that we enjoy in the UK and the Netherlands. And then we have new product, BPaid, coming online, which in itself is a very exciting financial opportunity. We've got some great opportunities there to take the business from what has been a difficult couple of years into something that is very, very different.
And out of say 10 million of total contract value, your TCV, how much of that would translate into ARR?
Yeah, so a good indicator is divide by 4.
Okay, so about 2.5. Okay,
there's a lot of variables around it, but divide by 4 and you're not far off. Our standard deal is something like a 5-year contract, and therefore you divide by more. But then we have cross-sell and upsell, which tends to reduce the average. So a good indicator is divide by 4.
Okay, good. Well, I mean, I think in that case, then, I just pointed out to investors, which might be of interest. I mean, businesses in this sort of space are sort of trading at around about 4 or 5 times ARR, and if you do 25 million of TCV and only 6 million of that drops down, that gives you effectively a top line ARR growth of double digits over double digits, which would certainly justify a 4 to 5 times revenue multiple. Now, given that, you'd be on 50 million of ARR times, let's say 4 to be prudent, 200 million EV. Take your debt away, then you get a share price of over £1.50. Now that's all hypothetical, but frankly, it gives investors, compared to a 30p share price or 32p share price, some indication of upside. If your strategy can work there, Tim, so there's a lot of people who have got a lot of hope for you there.
No pressure. The investors will be able to tell us how much the company is worth as we execute our strategy. All I can say is that it won't be for the lack of trying, and we have some great opportunity to go and do it. I think we are discounted at the moment. I think people are disappointed with what's gone on, but I think the opportunities are there for us, and we're pointed in the right direction, and we're shaping up pretty well to have a good shot at it. So let's go do it and see what happens. Yeah,
the one other area that has been of concern with investors has been the debt, and obviously the net debt is like 44 million, with I think it was 6 million of convertible on there, so you probably have around about 38 or 37 of sort of bank debt, etc. What are the plans to reduce that?
Yeah, so of course, growth is part of the leg, and we expect to see growth starting to come through even in these tougher times. However, having said that, because growth is less secure in these more risky times, we're also looking closely at OPEX and at product spend. So we expect to start returning the business to be cash flow generative over the next 12 to 18 months, we'll start to see net debt start to reduce on the back of that. And of course, if earnings are going as well in positive at the same space, then the gearing ratios start to come down and start to look normal pretty quickly. So we, as a fundamental part of the strategy check, we last year we agreed new banking facilities essentially out to 2022. So and those facilities are set against the current business plan, not the business plan that we thought we were going to be 3 or 4 years ago. So we're in a really good place with a really nice financial foundation. We accept that the gearing is high at the present stage, but everything's pointing in the right direction for that to come down pretty quickly, earnings to come up pretty quickly, and therefore we'll start seeing normalised ratios again fairly short.
Yeah, I mean, you've got sort of gross margins of near 90%, so your drop-through rate on incremental top-line growth is going to be pretty good, I would have thought.
It's pretty high.
And I mean, that's the one thing, is that it's the top-line growth and the sort of cash generation, which is the sort of the two differences. I mean, I was looking at the multiples of the business, and you're trading on 1.5 times sort of sales, etc., which actually is the lowest. I've not come across anything quite so low for such a high-value IPR software business in a perfect suite. So I think investors are definitely, if you're interested, have a good look at the sort of the valuation, the potential, the upside. What is going to be the what is going to be the news flow, do you think, over the next few? Is it really keep the business moving on the strategy, or?
I think the news flow is linked to the delivery against the strategy. So what we should expect to see is new business announcements in France, Germany, and the US against the single platform that's been sold into those territories. And also we should start to see buyer agreements come through Be Paid on the financial side. And as we start to see those happen, that's validation that the products are relevant in each of those spaces. So that's the logical news flow to come through over the next 3 to 6 months. Of course, it won't be too long before we get around to interims again in early February.
Brilliant. Okay, well, thanks very much for your time, Tim. I'm looking forward to hearing how the business progresses over the next couple of months.
No worries. Thanks, Paul.